What's up, everyone? Welcome back to the Walk of Wealth channel, where we talk about investing smarter, minimizing taxes, and building true financial freedom through passive investment in real estate and alternate assets. Before I get into today's video, I want to let everyone know about our in-person event that's coming up in sunny Miami, Florida, July 18th and 19th.
You're looking to invest money and you had a liquidity event, or if you have a little cash, you don't know where to put it and you want it to grow exponentially, you want passive income, this is the event that you have to be at. I'll see you next year.
All right, passive investment for dentists. Great seminar. I learned a lot today. I would recommend it to anybody who is aspiring to invest and make money for them.
As soon as you can get this information in your data bank, in that brain, and start implementing the strategies, boy, you're going to be able to live life and actually not be a slave to the dental practice. Your money is going to start to work for you, and you're going to enjoy life. You're going to have more time for your family and do some things that are outside dentistry.
Join me and 200 other like-minded dentists as we learn strategies, get access to investments from industry leaders, thought leaders, and true experts in all types of investing, taxes, retirement accounts, life insurance, private equity, oil and gas, you name it. We have absolutely amazing speakers there. Like I said, it's going down Miami, Florida. The tickets go up over time. Right now, we have early bird tickets at the time of this recording. Look at the website in the description below. Go grab your ticket today in the description below, and I'll see you in Miami, Florida. All right, guys, today I want to break down how ultra high net worth investors, and this is defined by people worth at least $100 million or more, think differently about risk, liquidity, and wealth management. Now, my job as a fund manager has allowed me to get in front of these type of people and actually have investors that are in this category, which has allowed me to pick their brains, learn on how they think about investing, and I want to share that here with you. Because here's the reality. It's not just about how much money you make, it's about how you structure it. Most people are obsessed with returns. Now, the wealthy, they focus on different things. They focus on risk. They focus on control. They focus on voting rights. They don't look at risk as, will I lose money? Instead, they ask different questions. Can I access my money when the right opportunity shows up? Is this liquid? Right? Do I have control rights? Do I have voting rights? And if you want to build wealth the right way, you need to start thinking like them, even if you're not there yet. And stick around, because we are going to be diving into the 3 types of money the wealthy use, why liquidity matters more than you think, and how you can apply these strategies to your own portfolio. Let's get into it. Most people think about risk completely wrong. They assume more risk equals more reward. The higher the risk, the higher the return. Stocks are risky, bonds are safe. Real estate is only for people with money. These are some self-limiting beliefs. But risk isn't just about returns. It's about access. What happens if an incredible investment opportunity comes your way, but you don't have the cash to take advantage of it? You've locked up a whole bunch of cash into your 401k plan, which you can't take money out of even if an incredible opportunity comes your way, and you can greatly increase your family's financial well-being, but instead the money's locked up. What if the market crashes and all your money is tied up in investments that you can't touch for 10 years? Now, that's real risk. This is why ultra wealthy investors don't just think about making money. They think about where their money is parked and how quickly they can access it when they need to. And that brings us to... Now, the wealthy divide their money into 3 key categories. Number 1, smart money. We call it smart money. That's liquidity money. Now, what is it? This includes cash. This includes stock portfolios. This includes HELOCs, right? Home equity lines of credit, business lines of credit, life insurance, whole life products, right? Infinite banking models, or anything that you can access in 3 to 7 days. That's considered cash. Now, why does it matter? This is the money they use for quick opportunities, market downturns, or strategic plays. Let's look at some examples. Margin accounts, borrowing against stocks, life insurance loans, accessing cash tax-free. This is literally tax-free money. You can borrow money against your life insurance policy. Check out our video on that if you want to learn more. Home equity lines of credit, business lines of credit, high yield savings account. Now, most investors ignore this and get stuck when big opportunities show up. Number 2, growth money. This money is higher returns, less liquidity, as compared to smart money. Now, what is growth money? Growth money is stuff that's invested in things like private equity, real estate syndications, venture capital, oil and gas deals, long-term investment. Now, why does it matter? This is the money that's locked up, but still generating high returns. Here's some examples. Buying a real estate syndication that cash flows for 7 to 10 years. Investing in a private equity deal that could give you 3 times, 5 times, 10 times, 20 times your money in 5 years. Funding startups or businesses with long-term upside. This money isn't liquid, but this is where the biggest wealth is built. Number 3, preservation money. This is long-term wealth protection. Now, what is this? This is trusts. These are estate planning strategies, and they're assets structured for generational wealth transfer to heirs. Now, why does this matter? This ensures that wealth isn't lost to taxes, unnecessary taxes, lawsuits, or poor management. Here's some examples. Setting up an irrevocable trust to protect your assets. Using estate planning to legally reduce tax burdens. Buying long-term real estate assets that appreciate and can be passed down on a stepped-up basis. Now, most people focus on maximizing returns. Ultra-wealthy investors focus on having the right money in the right places, right? Having the right buckets, identifying a strategy where you have different buckets, and allocating money into these different buckets congruent with the overall strategy. And why do we do it like this? Because wealth is built in cycles. During downturns like 2008, 2020, or future recessions, those with liquidity can buy assets at huge discounts. During boom time, they can invest confidently because they already have assets working for them. And if all your money is tied up in illiquid investments, you'll miss out on some of the biggest wealth building opportunities, because in your lifetime, you will be exposed to wealth building opportunities. Some will not realize it, some will ignore them, and some will capitalize on them. And some won't capitalize on them because they don't have any free liquid investment capital. And that's why having a balance of smart money, growth money, and preservation money is key. Let me give you an example. Now, let's say you're worth $100 million. You're investing $1 million into a real estate deal. This is a true example. We have a 9-figure investor, and he invests 7 figures at a time. Now, what are you going to do? Are you going to A, obsess over every tiny detail of the deal? Or B, you're going to trust the operator, trust the fund manager you vetted, and move on to the next opportunity. You see, the ultra wealthy don't waste time over analyzing deals. They spend time making more money. They vet the right team, they trust them, and they let them do their job. This is true of their investments. This is true of every aspect of their business. They get the right team in place, they trust them, they let them go and execute. Why? Because their income per hour is way too high to micromanage investments. If they can make $20 million per year running their business, they're not spending hours picking apart a deal that they're investing $1 million in. They know the best way to scale their money is by scaling their time. And if you're a successful dentist, entrepreneur, or investor, then you should be thinking the same way. Now, here's what I want you to take away from this video. Number 1, the ultra wealthy don't just think about returns, they think about control. Number 2, wealth is built by having the right money in the right places. Number 3, if you want to grow your wealth, stop micromanaging and start leveraging experts. So my question to you is this: which stage are you in right now? Are you focused on wealth accumulation, where you're making more, you're investing in growth? Or B, are you shifting into wealth preservations, protecting and structuring your assets? If you're not sure which one of these you are, make sure you look at part 1 of these 2 videos. Drop a comment in the comment section below and let me know. And if you found this valuable, make sure to like, subscribe, and share this video with like-minded colleagues, because understanding how the ultra-wealthy think is the first step to becoming one. See you guys on the next video. I'm Dr. Johnny Walker.